Hey guys, Toby Mathis here, and today we're going to go over the math behind whether or not you should convert a traditional account into a Roth account. Now, for purpose of this, I'm going to talk about IRAs and 401ks fairly interchangeably because you could always go from a 401k, traditional 401k, into a traditional IRA. But what we're really talking about is converting money that you took and received a tax deduction from, or in the alternative, if you didn't take a tax deduction because maybe your income was too high, the growth that is growing tax free is going to be taxable when you retire. And so we're able to do the math on this to see, does it make sense as I sit here today to convert whatever that amount is? Maybe it's $50,000, $100,000, $200,000, $300,000, whatever it is. Does it make sense to convert it and pay tax on that money now to get it into a Roth, where so long as I keep it in there for 5 years, I never have to worry about tax? As long as I season it, there's a 5-year holding requirement that I never pay tax on either the return of my money, the growth on that money, whatever it is. If I put in $100,000 into that account and it grows up to $1 million, I pay zero tax. If I put $100,000 in a traditional account and grows up to $1 million, I am going to pay tax on the growth on that money and the money, the whole amount. I'm going to end up taking that out as required minimum distributions or as distributions during my retirement, and I'm going to get hit with a tax on that. If I take it out too quick or too early, I might even be looking at penalties. So I want to go over the math on this and actually use calculators to explain it. Before I do that, I just want to give you a quick heads up on what you can do with your investments inside these types of accounts. Now, if you have an employer account, they're probably restricting the type of investments that you could do. They're probably going to give you a choice of like maybe conservative, more risky, and then high risk. Maybe you have 3 or 4 different flavors. Maybe you have as many as 5 to 10. It all depends on the administrator, but you're giving choices of basically doing mutual funds or ETFs. You're just getting buckets. You're not able to do the investments that you may want to do. That would require using something called a self-directed account or a self-custodial account or self-trusteed account if you were doing something like a solo 401k. Whatever the case, it is legal to buy real estate. It is legal to even run businesses inside these types of plans. There's tax consequences for doing so, but let's say you had something like a Rob's transaction, which is a rollover as a business startup, and you actually owned a piece of a business, a C Corp, that was operating. You can actually do that. There's ways to do these things. There's ways to own rental real estate, for example, in your own retirement account. I tend to gravitate towards the 401ks for those because we never have to worry about debt on any of those. If you're in an IRA, you have something called UDFI that we have to worry about. But there are ways to do alternative investments, syndications, private placements, things like that inside these accounts. And sometimes that bumps up the return. So the great example is Peter Thiel, who did PayPal inside of a Roth account and ended up having, I think it was $4 billion generated inside of a Roth account. That is the attractive nature of this. So he'll never pay tax on that $4 billion. The IRS tried. They said it's not fair. He made too much. And the court was pretty clear, like that's what the law says. You're not going to rewrite it. And that's not your job, IRS. That's Congress. Congress made it very clear that these things, the growth is tax free. That's why people go, gosh, I should do a Roth. But let's be real. What do you make on your investments? And then let's use that number, or we could use historical averages of like the S&P. It's a little over 10%. Maybe we just use 10%. But whatever the case, we should use your numbers before doing this calculation. Now, you could go to any financial planner and they could do what I'm about to show you, which is the calculation of whether it makes sense to do a conversion. There are a ton of tools out there. I'm just going to grab one from Voya because it was one of the first things that I saw on my list when I was typing in a Roth conversion calculator. So like, I don't really care whether it's IRA or whether it's a 401k. What I care is whether it was traditional money, whether I took a deduction when I put the money in, and whether that money is going to be taxable when I take it back out. So what we start caring about when we start looking at these numbers is how much am I going to convert? What is my tax rate on that money? Because if I convert it from a traditional to a Roth, I have to pay the tax on the growth, on the amounts that I haven't that I took as a deduction. I'm going to pay tax on that at my ordinary rate when I convert. So if I convert $50,000 this year, what is my tax rate? What is the growth of that money, and how long is it going to be in there before I take it out in retirement? And what tax rate would I be paying on retirement? So I can use those numbers and I can make a very educated decision. Now, here's a general rule that you can use to make this really simple. The IRS does not care whether it's a Roth IRA or a traditional IRA, and that is because based off of everything being equal, they're roughly equivalent. In other words, if your tax bracket does not fall when you retire and you took a deduction and then you're going to pay tax on that same level, let's say it's 20%, then you waited 30 years to retire and you grew at 10%, the amount of tax you ultimately pay will be roughly equivalent whether it's a Roth or a traditional. That's why they don't really care. They're going to get paid. Sometimes it's sooner, sometimes it's later. Like in a traditional IRA, they're giving you a tax break now, but they're going to collect their taxes later. At the end of the day, it doesn't make a difference. Where it does make a difference is if your tax rate is higher now and lower later, or lower now and higher later. And here's how it affects you. If you are in a high tax bracket now, but when you retire, you expect it to go down, you are better off using a traditional retirement account because you get a deduction at this high amount. You get a tax deduction that is really tough to make up if you don't get that tax deduction. In other words, if I put in $5,000 and I'm at the 20% tax bracket and it's in a traditional IRA or traditional 401k and I'm at 20%, my tax savings are $1,000. If I do not get that deduction, I put it in a Roth, I'm immediately $1,000 behind. Make sense? In other words, I put in $5,000 in a traditional and I'm at 20%. Then I am really getting a tax. I actually have a benefit of $6,000 because I saved $1,000 in tax. If I did that with a Roth and I did not get a deduction, it's $5,000. So I'm $1,000 ahead with the traditional. Flip that around. If I'm in a low tax bracket right now, but I expect it to go higher when I retire, then I'm going to be better off using a Roth. For example, if you have children, 16, 17, 18, whatever they are, and they're making $10, $11, $12,000 a year, their tax bracket is zero. Their tax bracket only has one direction it can go, and that's up. They're going to be better off using a Roth. If you can do a Roth IRA as a savings account for your 15, 16, 17, 18-year-old, that's great. 20, 21, 22, when they're off on their own, they can be doing their own Roth IRA. You can be doing a custodial account otherwise. But the idea is that their tax bracket's going to go up when they retire. If you are at the highest tax bracket and you're going to do a conversion and you're like 50 years old, I'm probably going to look at you funny and say the math isn't going to back that up because your tax bracket only has one direction it can go, and that's down. And if it goes down, you're better off doing a traditional. But enough of me. Let's actually look at the math so you know for yourself, does it make sense? So I'm just going to grab this little conversion calculator. I went to Voya just because that was the first thing that popped up. There's nothing magic here. There's a whole bunch of these all over the internet. You just look at an IRA conversion calculator or a Roth IRA conversion calculator or a 401k conversion calculator. You're going to get to the same place. And what we care about is we're going to look at, really, they use three numbers because you have to factor in the tax hit when you do the conversion. Now, here's your choices when you do that, when you get that tax hit. I could either pay the taxes out of the account. So, for example, I just did $50,000. I'm not going to put in any non-deductible. Like this is if you were you didn't get a deduction when you put the money into the account. But let's say that we got $50,000 in a 401k or IRA. It doesn't really matter. Let's say that I'm 45 years old and I have 20 years before I have retirement. So I just put in there 65 years. Let's say that my rate of return is 7% and my current tax rate is 24%. That means I have $12,000 of tax on if it's at 24%. When I convert that 50,000, I have to pay taxes of $12,000. So it's at 24%. I'm at the tax bracket here that puts me in that range. At 24%, that's between 95,000 and 182,000. I'm in the 24% tax bracket on that 50 grand. Let's just say I make $100,000 a year. So that extra 50,000 is going to cost me 12 grand. And I have two choices: pay it from the account and reduce the amount. So let's say I take that 50,000 and I pay $12,000 of tax. I could reduce the 50. Now that'll be down to $38,000 because I paid the 12,000 out of it. So I take 50,000 minus 12. I'm at $38,000. It's going to take a while for me to make up that tax hit. Or I could take the $12,000 out of my pocket and pay the taxes directly. That's what most practitioners would tell you to do. They'd say, if you're going to do this conversion, put as much money in that Roth as humanly possible. So come out of pocket that $12,000. So we have to do that math. And we have to look and say, apples to apples, what does it look like when we compare that Roth to the traditional? Then we have to look and say, let's say our current tax rate is 24%, but what do we expect it to be when we retire? Well, if I'm making, let's say, 50 grand a year when I retire, 50, 60, and I have a standard deduction that's going to knock that down to about 40, my tax rate on that money is really 12%. And let's say that I'm getting a rate of return. I use 7, but let's just say it's the S&P. So let's say it's 10%. Investments is also tax rate is at 10%. That's if I have dividends, et cetera, or long-term capital gains. So I need to look at the math and decide, how am I better off? Am I better off doing the conversion or not? And based off of those numbers, it's very clear it's not going to be worth it under that time frame. So 20 years, if I go from a 24% tax bracket down to a 12, it's probably not going to make sense. Here it is. I'm making $363,000 when I look at the traditional, and I factor in that $12,000 tax payment as being when I add that back in, because I have a benefit of not having to pay that. I actually got a deduction when I put all these monies in. So I'm comparing apples to apples. I'm looking at them straight across. I'm a little bit better off to be a traditional, and that makes sense. That makes sense to me. If I just looked at the money in a traditional IRA and I removed the tax dollars, then I'd be better off doing the Roth conversion. So some practitioners would say, if you come to the table with the cash, you may actually be better off, but that's not being fair, because I have to look at the tax deduction. Now, if this was all non-deductible contributions, and I never got a tax deduction for putting money in my IRA. In other words, I'm one of those people that overfunded my account and I didn't qualify, then it's going to make sense to do that Roth conversion, because I'm not going to have to pay tax on that money. I never took a deduction on the 50,000, so when I convert it, I'm not going to have that tax hit. And all of a sudden, the Roth starts to make more sense. That's almost never the case. Usually, when we're doing these, we're doing the IRA contributions, or we're doing the 401k contributions because we want the tax deduction. So let's use real life example. Let's say that I have $200,000 in my IRA, and you're itching, or it's somebody you know, and they're saying, I'm going to convert it. And they got deductions the entire way. Let's say this was a 401k, and every year they were putting $20,000 in that thing, or whatever their employee amount was. Maybe their employer was even matching, but whatever the case, you ended up with $200,000 that they never had to pay tax on. They got a deduction for that money, and they're going to end up paying tax when they retire. Let's say that they are 50 years old and they're going to retire. Let's just say conservatively, we're at 75. They're going to retire at 75. The rate of return, again, we'll keep it at the S&P just to be fair. The higher it goes, the more likely it's beneficial to the Roth. So if we went and we said 7%, these numbers look quite a bit different. And it starts to even be stronger in favor of the traditional plan. But let's just say we're going to use 10%. Our current tax rate, because that 200 grand is going to pour in on top of whatever we're making. I think we were at the 24%. Now, all of a sudden, that $200,000 is going to push us into the 32 and 35% tax bracket. So let's just say, I'm just going to say that money on average is at 33%. Now we're not even close. You are going to lose a ton of money. If it's $200,000, I'm losing, and I have 25 years. Oh my gosh, I really do lose quite a bit of money. It looks like it could be as high as 300 grand that I'm going to cost myself over time because I did that conversion. That's why we don't really like those. Now, if we're at 33%, we have this much money, I probably should adjust this. Maybe I'm at 22%. This is going to make the money look a lot closer. Still going to cost me about $92,000 to be fair. Now, what is your situation? Maybe you are sitting there and you're looking at, or you heard somebody who says, I'm at 100 grand. They're 55 years old. They're thinking, they're in the 37% tax bracket, and they're itching to do that conversion. It's almost never going to make sense. When I run those numbers, it's not even close. I only have 10 years. You're going to see the longer period of time you have before you retire, the better off. So if I said my age of retirement, let's say that I'm going to use 35 and I'm going to give myself 40 years, these numbers they get a lot closer, even when they're this extreme. But if you are in the highest tax bracket and you're talking about doing conversions, it's really, really tough to make this stuff pencil. Now, if you have your beat on returns of 20% or north of 20%, you're just really good at your investments, and you know that there's companies that are private companies that you can invest in, then when you start jumping in that higher return, the Roth becomes your friend. But we can't factor that. I legally, most people can't go over above 7%. If they're a fiduciary, they're going to have to use that number. It's not even close. And we just have to look at that age of retirement. Now, this is pretty straightforward. If it's $5,000 and I'm doing a conversion, and let's say that I was 18 years old and my retirement age is going to be 65, my rate of return is going to be a historical average of the S&P at 10%, and my current tax rate is 0, and my rate when I retire is going to go up maybe to 12%. Now it's not even close. The Roth makes the sense. The Roth makes the most sense. That's only if you're at that 0. Now, what if I change this up slightly, and let's say that you're an investor and you understand what real estate professional status is, or you understand how to use cost segregation, and you're going to do a short-term rental to cause yourself a little loss in the first year, and it's going to offset your conversion. Now we can go and say our current tax rate on that conversion is 0. Our rate of return is that same 10%. My current age, let's say that I'm 35, or better yet, we'll say that I'm 45 and I'm thinking of doing that. Now we only have 20 years. You could still see the numbers are in your favor under those circumstances. All this is saying is that you do the math on your scenario, not anybody else's, on your scenario, to see whether or not it makes sense. And you want to be honest with yourself about your returns and say, what have I received? Because you might be in this range. You might be looking at going, hey, historically I made 8%. I didn't always beat the market. I've blah, blah, blah. Maybe, hey, when I retire, I'm going to be making, let's just say that maybe it's you and a spouse, and you're going to be making around $100,000 a year. You might put in that 22%. All of a sudden, it starts even looking better and better if you can have an offset against that. But maybe I don't get the offset. Maybe my current tax rate, it's you and a spouse, you're making 24%. This is going to make it really, really close. It's almost a push. You're looking like, yeah, the IRA could increase $3,000 with a conversion under those numbers. Like, it always matters. Remember when I said it's almost a push when if your tax rate doesn't move? That's why the IRS doesn't really care. The IRS, Congress says, hey, we don't really care. We don't lose any money realistically because we're going to forego the tax deduction, or you're foregoing the tax deduction. So if they allow you to do the Roth, the government gets paid now more money. If they gave you the deduction, then the IRS and the government is foregoing the amount of money, and they're going to collect it over time, versus versus a Roth. Hey, you get no deduction, so they're getting more money now, but they're going to get less money later. At the end of the day, they end up in the same place, all things being equal. So it really comes down to your scenario. Again, the easiest way I could keep, I'm going to reiterate this one last time. The rule of thumb is if your tax rate is going to go down when you retire, and if it's going to go down considerably, like you're in the highest tax bracket, there's only one way it could go, and that's down. And if you're a real estate investor, when you retire, you're probably not going to be paying much tax on that income anyway. Then it doesn't make sense to do those conversions unless you're going to get astronomical returns. And I just can't use that in a calculator. I'm never going to do that because I would say the chances of that happening are so slim. So Peter Thiel, if he had walked in and he said, hey, I'm going to do this deal, blah, 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 most practitioners would look at him and say, you can't really bank on it. But he didn't have a whole bunch of other income maybe at the time, so there wasn't a cost to doing the conversion, in which case people would say, oh, your tax rate's really low now. It might be higher when you go up. So yeah, do the Roth. That's always going to be the situation. If it's high now and it's going to be low later, do traditional. If it's low now and your tax rate's going to be higher later, do the Roth. That's all you really have to know. And then you have to do the calculations on a conversion to make sense that you're going in with your eyes open. And remember, you don't have to convert the entire amount in 1 year. You could be doing this over multiple years. I could convert $50,000 a year of a $200,000 account and spread it out over 4 years to make the numbers work. You don't have to do anything. You could do things very strategically. Just make sure that you're running those numbers. Hey, if you know anybody that could benefit from this, share it with them, because there's a lot of crappy information out there, people doing these conversions and they hurt themselves and they're never going to make it up. They end up paying this huge tax bill, and then they're really frustrated because they didn't realize how much it was going to cost them when they did that conversion. And that money's out of their pocket and that tax is due and owing, and it's not very forgiving. So if you know anybody who's thinking about doing that conversion, just share this with them so that they can at least make an educated decision, and then make sure that they're talking to a fiduciary, CPA, attorney, tax attorney, a CFP, somebody that can do the calculations for them so that they're walking in with their eyes wide open as opposed to wide shut. All right, guys, that's it. And give me some ideas down in the comments too. Let me know what you think, and then anything else you want me to cover. If you want me to go over some examples, again, you give me some real numbers, I might do that too, and we'll do a video on actually doing live. Here's case studies. I'll remove your names and everything else, but if you give me some of those facts, it might be fun to run those numbers. All I need to know is what's your current tax bracket, what you make every year, married, filing jointly, or single, that type of information, so I know what bracket you're in, how much you're thinking of conversion, and what you think you're going to make on those investments, and how many years until you retire. And I'd be able to run that math, and it's kind of fun when you do it because it starts to make it real to you. All right, hope you guys benefited from this. Share it with anybody, like and subscribe. See you guys later.